Imagine saving up for years, finally signing the papers on your $400,000 dream home in Florida, and then bam, a Category 4 hurricane hits.
Yeah, worst nightmare scenario right there.
Literally. So the damage is extensive. You call your insurance company completely expecting relief, only to find out they won't pay a single dime until you hand over $40,000 in cash out of your own pocket.
Just entirely out of pocket.
Right. Welcome to the reality of the 2026 Florida real estate market.
I mean, that $40,000 surprise, it's destroying nest eggs entirely.
Yeah.
The margin for error for buyers right now is, well, it's practically non-existent. You are navigating this intense financial gauntlet where just one misunderstood clause can completely derail your financial future.
Which is exactly why we are dedicating today's deep dive to unpacking this entire ecosystem. We grabbed a massive stack of sources to give you, the listener, a definitive masterclass on surviving and actually winning in this market.
Because you really can win if you know the mechanics.
Exactly. So we have the 2026 UQual Mortgage Credit Guide, a deeply comprehensive latent insurance report focusing specifically on Florida, transaction timeline data from local Tampa Bay realtor Barrett Henry, the Florida Realtor's official legal library, and this is cool, we even pulled real customer reviews from a local lender, Florida Homeowners, LLC.
It's a lot of data, but it's vital.
It is. Our mission today is to synthesize all of this data and teach you how to hack this uniquely challenging Florida system.
Because the system is complex, sure, but it is highly predictable once you understand the underlying mechanics. If you learn the rules of this specific market, you can totally leverage them to your advantage.
Okay, let's unpack this. Before you even think about looking at palm trees and beaches, you have to look at your credit profile. The UQual data lays out the baseline rules for the different loan types.
Right, the foundation of the whole process.
Yeah, so I want to start with the Federal Housing Administration, or FHA loan, because this is the traditional gateway for first-time buyers. The program minimum credit score is surprisingly low, like just a 500. So how does a score that low actually play out in reality?
Well, a 500 score gets you in the door, but it comes with a really heavy risk mitigation penalty from the government. If your score sits between 500 and 579, the FHA requires a mandatory 10% down payment.
Wow, okay, so a much higher upfront cost.
Exactly. They're forcing you to have more skin in the game because your credit history suggests a higher risk of default. Now, if you want access to that highly advertised 3.5% down payment option, the one everyone talks about, you absolutely must cross the threshold of a 580 credit score.
Got it. Let's talk about the mortgage insurance premium, or MIP, because the source data frames this as a massive hidden trapdoor for FHA buyers. I need you to explain the mechanics of this because it sounds like a permanent penalty.
It really is. And mortgage insurance is fundamentally misunderstood by so many buyers. It is not an insurance policy that protects you if you lose your job.
Right. It's not for the buyer at all.
Not at all. It is a policy that you are forced to pay for, which protects the lender in case you stop making your payments. And every single FHA loan requires it. Mechanically, it hits you twice. First, there is an upfront premium of 1.75% of the base loan amount.
Which is huge.
Yeah, though most people just roll that into their total loan balance. But second, there's an annual premium of 0.55%, which is divided up and added to your monthly payment.
Okay, so every single month you're paying this extra fee.
Every month. And here's the permanent penalty you mentioned earlier. If you put less than 10% down, which, let's be honest, is the vast majority of FHA buyers, that monthly MIP charge lasts for the entire life of the loan.
Wait, really? The entire 30 years?
The entire 30 years. In the past, or with other loan types, mortgage insurance falls off once you build enough equity in the home. But with a low down payment FHA loan today, you carry that extra monthly cost until the day you sell the house or refinance into a completely different loan.
So you are basically paying a permanent tax for the privilege of a lower barrier to entry. That's rough.
It really is.
Well, that makes the data on VA loans look almost utopian by comparison. The UQual guide positions the Department of Veterans Affairs loan as the undisputed heavyweight champion for eligible military members.
Oh, the benefits are genuinely unmatched. Technically, the VA does not even set an official minimum credit score.
Right. No minimum at all.
Not officially, though the private lenders actually writing the checks usually look for a baseline between, say, 580 and 620. But if you qualify, you get a 0% down payment, absolutely no private mortgage insurance requirement, and interest rates that reliably sit 1/4 to 0.5% lower than conventional market rates.
That is a staggering financial advantage over the life of a 30-year term. I mean, no down payment and no mortgage insurance. unbeatable.
Truly unbeatable.
But for civilians, we have to navigate the conventional loan market. The floor here is a strict 620 minimum credit score, and the UQAL math showing the penalty for merely scraping by with that 620. It's just mind-blowing. Give us the breakdown of what a low score actually costs you.
Right. Let's look at a standard $300,000 loan.
Yeah.
If you barely qualify with a 620 credit score, your interest rate is going to be significantly higher, and your private mortgage insurance premiums will be drastically inflated compared to a buyer coming in with a strong score, like a 760 or above.
Because you're seen as a much higher risk.
Exactly. When you calculate that higher rate and the higher PMI together, the 620 score costs you over $200 extra every single month. Over a standard 30-year mortgage, that adds up to more than $70,000 in completely avoidable additional costs.
$70,000 lost simply because of a 3-digit number on a credit report. That could buy an entirely new kitchen, a new roof, and a vacation.
It's a massive amount of lost wealth.
It is. But the UQAL guide does offer a silver lining here. Fixing a damaged credit score doesn't necessarily take years, right? The data says disputing an actual error on your credit report can force the bureaus to update your file, boosting your score by 20 to over 100 points in just 30 days.
Yeah, that quick turnaround is totally possible.
And even just paying down a maxed out credit card to lower your utilization ratio can trigger a 30 to 50 point jump in a matter of weeks. So you aren't permanently stuck.
No, you have a lot of control if you actively manage it.
There is a concept in the data, though, that I want to push back on. The guide talks extensively about lender overlays.
Ah, yes, overlay.
I conceptualize overlays like a nightclub bouncer. The club's official website says the dress code is casual. That represents the government saying an FHA loan only requires a 500 score. But you show up in a t-shirt, and the bouncer at the door demands you wear a blazer.
That's a great analogy.
Right. The individual lender demands a 580 score to actually give you the money. Why does the bank get to change the government's rules at the door?
If we connect this to the bigger picture, you have to follow the actual money. The government agencies like the FHA and the VA, they do not lend money. They simply insure the loan.
Oh, okay, so they aren't writing the check.
Exactly. The private bank is the entity handing over $300,000 of their own capital. Because the bank holds the immediate liquidity risk, they pad those government minimums by 20 to 40 points.
That makes sense.
Yeah, that overlay is their institutional safety buffer. The government might say a 500 is theoretically acceptable, but the bank's internal risk models demand a 580 to comfortably release those funds.
That distinction makes a lot of sense. So you navigate the overlays, your credit is polished, and you get your pre-approval letter. Now the dynamic completely shifts. The clock starts.
The clock starts ticking very loudly.
Looking at Barrett Henry's timeline data for the Tampa Bay area, we move from the theoretical preparation to the sheer velocity of a Florida transaction.
Yeah, the transition from the house hunt to the executed contract is where buyers experience extreme psychological whiplash.
The data maps this out perfectly. The hunt itself takes an average of 2 to 5 months. It's this slow burn of going to open houses, getting outbid, looking at Zillow at midnight.
Right, it feels like it takes forever.
But the second a seller finally accepts your offer and you sign that contract, you are thrust into a highly aggressive 45 to 60-day sprint to the closing table.
It's an all-out sprint.
And the most intense part of that sprint is the due diligence window, right?
Absolutely. That window is incredibly unforgiving. You generally have just 10 to 15 days to execute every single inspection, coordinate the appraisal, and uncover any hidden flaws in the property.
10 days to figure out if you are buying a dream home or an absolute money pit. I mean, finding a catastrophic plumbing issue on day 16 means you either buy the broken house or you walk away and legally forfeit your earnest money deposit.
Which could easily be $10,000 or more.
Exactly. So having a team that communicates instantly isn't just nice to have, it is a financial necessity. I was reading through the customer reviews from Florida Home Loans, LLC, which the source material highlights as an elite local team. They have a 5.0 rating across nearly 350 reviews.
That's a very rare rating in this industry.
Right. And there was one specific review from a buyer named Oscar that really stood out. His loan profile sounded highly complex. How did this team actually navigate a complex VA loan and get him to the finish line in under 30 days?
Well, the mechanics of closing a complex loan that quickly, it all comes down to preemptive communication and treating the file with absolute urgency. Oscar specifically praised the team, Eric, Jorge, Chad, Leanna, and Daniel, because they eliminated the standard banking delays.
What do you mean by standard delays?
Well, normally, when an underwriter needs an extra document, a typical bank might take 3 days just to email the buyer. But this team, they secured the document immediately. Flawless communication condenses a typical 45-day timeline into 28 days.
That is incredible. But Barrett Henry's data notes that cash buyers can close a transaction in just 7 to 14 days. If a heavily motivated buyer with a great mortgage team still needs 30 to 45 days, and a cash buyer only needs 7, are cash buyers just recklessly skipping that crucial 10 to 15-day due diligence phase to win the bidding war?
It is a super common misconception, but no, smart cash buyers are not skipping due diligence. The massive time savings comes entirely from eliminating phase 5 of the timeline.
Which is what exactly?
That's the lender's underwriting and processing gauntlet. Underwriting is where a human being meticulously verifies your W-2s, checks your tax transcripts with the IRS, scrutinizes your bank statements for large deposits, and waits for a third-party appraisal to confirm the home's value for the bank's collateral.
That sounds exhausting.
It is. And that specific bureaucracy takes 2 to 4 weeks. Paying cash bypasses the underwriter entirely. But even with a briefcase full of money, bypassing a Florida home inspection is catastrophic. You absolutely need those 7 to 10 days to ensure the foundation is solid and the roof isn't rotting.
Which brings us to the single biggest threat lurking inside that due diligence window. The thing most likely to blow up a Florida real estate deal isn't finding a leaky pipe. It's finding out that the leaky pipe makes the house legally uninsurable.
Oh, what the insurance market right now is terrifying.
We are looking at a 2026 report from Leighton Insurance, and the baseline numbers are staggering. The national average for homeowners insurance is roughly $2,100 a year. But in Florida, a statewide average budget requires $3,800 to $6,000.
And the localized extremes are even more severe than that. If you are targeting coastal regions like Miami-Dade or Broward County, the baseline budget explodes to $7,000 or even upwards of $14,000 annually.
$14,000 a year just for insurance. That is insane. And getting a policy approved in the first place hinges entirely on 2 highly specific inspections that out-of-state buyers have likely never even encountered. I want to break down the mechanics here, starting with the 4-point inspection.
Right, to 4-point.
This costs about $125 and is mandatory for homes older than 30 to 40 years. It scrutinizes the roof, the electrical, the plumbing, and the HVAC systems. This inspection is purely about eligibility, right?
Exactly. The 4-point is a binary pass or fail for the insurance carrier. They are looking for specific systemic liabilities. If you have an outdated electrical panel known to catch fire or like polybutylene plumbing pipes known to burst, you will fail.
And what happens if you fail?
A failure means you are completely uninsurable in the standard market until the seller replaces those systems. And if you can't get insurance, your lender refuses to fund the mortgage and the deal dies on the spot.
Wow. Okay, so once you clear that eligibility hurdle, you face the wind mitigation inspection, which costs around $75 to $150. This one is entirely about price. It documents the geometric shape of your roof, whether you have impact-resistant glass, and most importantly, how the roof is physically attached to the walls of the house.
Yes, the roof-to-wall connections are crucial.
Here's where it gets really interesting. I look at this wind mitigation inspection like buying a VIP wristband at a music festival, but with a structural twist. To get the wristband, you have to prove to the bouncer that your roof is literally strapped to the concrete walls of the house with specific metal clips so hurricane winds can't tear it off.
That's a great way to visualize it.
Right. So it costs you $150 up front to prove that to the inspector. But once you have that verified wristband on, it saves you an absolute fortune at the bar all year long. You pay the inspector once, and you might legally force the insurance company to cut the windstorm portion of your premium by 10 to 50%.
And that saves you thousands of dollars every single year.
It's massive.
It is mathematically the best return on investment a Florida buyer can execute. Earning those mitigation credits is absolutely essential for affordability. But this raises an important question regarding how buyers manipulate their policies to actually afford these premiums, specifically regarding the hurricane deductible.
Oh man, the hurricane deductible is where the Leighton Insurance report gets genuinely terrifying. In most states, a deductible is just a flat fee, A tree falls on your house, you pay a $1,000 deductible, and the insurance covers the remaining $50,000 of damage. But Florida law mandates that the hurricane deductible is a percentage of the dwelling's total insured value. Carriers offer 2%, 5%, or 10% options.
And this is where we need to revisit that $40,000 shocker from the beginning of our deep dive. What's fascinating here is the psychological trap built into the pricing structure.
Walk us through that trap.
Let's assume you are insuring a home valued at $400,000. A 2% deductible means you are financially responsible for the first $8,000 of damage from a named storm. That's rough, but manageable for some. But a 10% deductible means you are on the hook for $40,000 before the carrier writes a single check.
Why in the world would anyone voluntarily choose a 10% deductible and risk a $40,000 bill?
Buyers choose it out of monthly desperation.
Oh, because it lowers the premium.
Exactly. A first-time buyer who is stretching their debt-to-income ratio to the absolute limit will see that selecting a 10% deductible drastically lowers their monthly insurance premium. They trade a lower monthly bill today for the statistical likelihood of total financial ruin tomorrow. They are legally making themselves responsible for catastrophic wind damage that they simply do not have the liquid cash to repair.
So you are literally playing Russian roulette with a Category 4 storm just to save $100 a month. That is wild. Oh, and to add insult to injury, the source material explicitly notes that a standard homeowner's policy never covers flood damage.
Nope, never.
Storm surge from a hurricane or rising water from a torrential downpour is completely excluded. You have to purchase a separate National Flood Insurance Program policy or find a private flood carrier.
Which is just another added cost you have to budget for.
Right. So say you survive the credit matrix overlays, you beat the aggressive 45-day timeline clock, you navigate the 4-point insurance gauntlet without accidentally taking on $40,000 of uninsured storm risk. You are finally at the closing table.
You're there. But there's a final layer of legal bureaucracy waiting at that table: community associations.
Yes, we pulled the regulations from the Florida Realtors Legal Library, and the state treats condominiums and homeowners associations entirely differently. The distinction is massive. Let's look at the strict consumer protections for condo buyers first. Florida law provides a mandatory 7-day cancellation period. The clock starts ticking the exact moment the buyer receives the current condo documents, the financials, the bylaws, the frequent assessments.
And weekends and holidays do not count toward those 7 days.
Right. During those 7 days, a buyer can walk away for any reason whatsoever. Furthermore, condo transfer and screening fees are capped by statute at a maximum of $150 per applicant. If the condo requires a security deposit for a renter, it is strictly capped at 1 month's rent.
The state imposes hard limits on condos to prevent exploitation.
But then you turn the page to homeowners associations, or HOAs. HOAs have no statutory cap for transfer fees. They have no statutory cap for security deposits. The state law merely dictates that the amounts must be reasonable based on the community's specific governing documents.
Reasonable being a very subjective term.
Extremely subjective. Why does Florida law strictly protect a condo buyer with a $150 fee cap and a 7-day escape hatch, but leave an HOA buyer entirely at the mercy of whatever an unelected board deems reasonable?
It fundamentally comes down to historical legal distinctions regarding structural density and shared liability. A condominium is a highly dense, shared wall structure. The financial health of the overall association directly impacts the structural integrity of your specific unit.
Because you literally share a roof.
Exactly. If a condo association goes bankrupt and defers maintenance, the shared roof over your head might literally fail. The state legislature recognized that condo buyers require a mandatory cooling-off period to heavily scrutinize those shared financials, and they capped fees to prevent boards from financially exploiting buyers in dense buildings where they have no alternative.
Okay, that makes sense for condos. What about HOAs?
An HOA, historically, governs spread-out, single-family homes. The HOA maintains the community pool, or the landscaping, but you, the individual homeowner, are solely responsible for the roof and walls of your own structure. The state views HOA buyers as having significantly less immediate structural shared risk, and therefore defers the fee structures and rules to the individual community's recorded declarations, subject only to a highly subjective legal standard of reasonableness.
Okay, that distinction regarding shared structural liability actually clarifies a lot. There are 2 other rules in the Realtors Library that buyers really need to memorize. First, dealing with foreclosures. If you buy a foreclosed property and discover a tenant currently living inside, Florida law dictates you do not have to honor their previous lease agreement. You possess the right to give them a 30-day notice to vacate the premises.
Which is a huge relief for buyers who want to move in immediately.
Yeah, definitely. Second, the library details investment caps. Associations possess the legal authority to place a hard cap on the total number of rentals allowed within the community at any given time.
And that rental cap is heavily misunderstood by the public. It isn't just a mechanism to keep the neighborhood quiet or prevent short-term vacationers. It is an absolute financial necessity to protect property values.
Really? How so?
Well, if a community allows too many investor-owned rentals and the ratio of owner-occupants drops too low, government-backed entities like Fannie Mae and Freddie Mac will categorize the entire community as a non-warrantable property.
Non-warrantable.
Yes. When a property becomes non-warrantable, mainstream mortgage lenders will simply refuse to approve conventional loans for any future buyers in that neighborhood. Associations enforce strict rental caps to ensure that future buyers can actually secure a mortgage to purchase a home there.
That is fascinating. So what does this all mean for you? It means that acquiring real estate in Florida in 2026 is no longer just about picking a house with an updated kitchen and a nice view. It demands strategic credit preparation months in advance to bypass lender overlays. It requires an aggressive local team that can execute a flawless due diligence sprint in under 15 days. It forces you to understand the mechanical difference between a 4-point eligibility inspection and a wind mitigation pricing inspection, so you don't fall into the hurricane deductible trap. And it requires you to scrutinize the shared liability of HOA and condo bylaws. But armed with this precise knowledge, you are equipped to control the transaction rather than letting the transaction control you.
Well said. But before we conclude, there's one final, really thought-provoking detail buried deep within that UCOol all-source data that could entirely rewrite your purchasing strategy.
Oh, I always appreciate a hidden mechanism. What is the detail?
It is the energy-efficient DPI loophole. We noted earlier that FHA loans have strict financial parameters. Typically, the FHA caps your debt-to-income ratio, or DTI, at 43%. Your DTI is simply the percentage of your gross monthly income that goes toward paying debts. If your proposed mortgage and existing debts consume more than 43% of your income, you are denied the loan.
Right, they draw a hard line.
However, the guide outlines a very specific exception. If you are purchasing a home that is officially certified as energy efficient, the FHA allows you to push that DTI limit up to 45%.
Really? Wait, stretching your debt-to-income limit by an extra 2% might sound minor, but on a mortgage calculation, that can equate to tens of thousands of dollars in additional buying power.
Exactly the point. So I leave you with this final thought to explore on your own. Could you strategically hunt for a Florida home that is heavily hurricane hardened, featuring the metal roof clips and impact glass that earn you massive insurance discounts, that is also highly energy efficient?
Oh, wow. I see where you're going with this.
If you find a property with that specific mechanical combination, you could legally leverage the energy efficiency to qualify for a significantly larger mortgage, while simultaneously leveraging the hurricane hardening to keep your monthly insurance and utility costs drastically lower.
That is the ultimate Florida real estate hack. You use the home's environmental efficiency to compel the bank to lend you more capital, and you use its structural safety to force the insurance company to charge you a fraction of the standard premium. My mind is honestly blown. You've got your credit roadmap, the reality of the timeline sprint, the VIP wristband strategy for insurance, and the structural logic behind community associations. You are officially ready to navigate the gauntlet. Thanks for joining us on this deep dive, and we'll see you next time.